On January 7, 2026, Wall Street witnessed a financial earthquake. J.P. Morgan Chase, America's largest bank, officially agreed to take over Apple's entire $20 billion credit card portfolio from Goldman Sachs. This move didn't just end Goldman's disastrous billion-dollar experiment in consumer banking, it rewrote the rules of financial power. This isn't just a corporate headline, it's a masterclass in strategy, negotiation, and market dominance. And if you're one of the more than 12 million Americans holding an Apple Card, this story directly affects your wallet. Today, we're diving deep into exactly what happened, why Goldman Sachs failed so spectacularly, how J.P. Morgan managed to secure a billion-dollar discount, and what this all means for the future of your money and banking. Let's start by looking at the titans involved in this massive deal. First, you have J.P. Morgan Chase, a true behemoth with over $4.5 trillion in assets. They're already the #1 credit card issuer in the country, serving a staggering 85 million consumers. Then there's Goldman Sachs, the elite Wall Street investment bank with a 150-year history of advising governments and corporations. They tried to jump into consumer banking with their brand Marcus, launching the Apple Card partnership back in 2019, a decision that would ultimately cost them billions. And finally, we have Apple, the most valuable company in the world. Their Apple Card attracted over 12 million customers, and its growth was explosive, jumping 53% annually in its early years, while the rest of the industry chugged along at 4 to 6%. Now, let's break down the staggering numbers of this deal. The credit card portfolio itself holds $20 billion in balances. J.P. Morgan shrewdly acquired it for more than $1 billion below its actual value. To handle the expected risks, J.P. Morgan set aside a massive $2.2 billion for potential credit losses. For Goldman, selling this portfolio boosted their earnings per share by 46 cents, a small silver lining to a very dark cloud. The entire transition from Goldman to J.P. Morgan is expected to take about 2 years, and while $20 billion sounds huge, for a bank the size of J.P. Morgan, it represents just 1.3% of their total loan book. It's a small piece of a much larger puzzle, but a very strategic one. So, where did it all go so wrong for Goldman Sachs? This was a billion-dollar disaster, and it came down to a few fatal mistakes. First, they targeted the wrong customers. In a rush to please Apple and maximize iPhone user adoption, Goldman approved far too many customers with FICO scores below 1660, which is considered fair to very poor credit. They simply didn't understand the risk they were taking on. This led directly to their second problem, higher than expected defaults. Delinquency rates soared as customers failed to make payments, and the portfolio started hemorrhaging money. Third, they faced an operational nightmare. Apple customers' billing cycles were all concentrated at the end of the month instead of being staggered. This created massive, unpredictable cash flow swings and completely overwhelmed their customer service teams. But the biggest problem was a simple lack of DNA. Goldman Sachs is built to handle billion-dollar mergers and advise giant corporations. They had zero experience running a large-scale consumer credit operation, and it showed. The criticism from Wall Street was brutal. Wells Fargo analysts called the Apple deal a disastrous consumer lending expansion for Goldman Sachs that never should have happened. They were baffled that Goldman poured so many resources into a consumer business they were so ill-equipped to run. By 2023, Goldman's entire consumer division, Marcus, was bleeding billions. CEO David Solomon was facing intense pressure from shareholders and his own board. The writing was on the wall. They began a systematic retreat, selling their General Motors credit card business to Barclays, their Marcus Invest platform to Betterment, and the fintech firm Green Sky. The Apple Card was the final massive piece to fall. When the deal was announced, David Solomon stated, "This transaction substantially completes the narrowing of our focus in our consumer business." You can read between the lines. We failed. We're getting out. So if this portfolio was such a disaster for Goldman, why on earth did J.P. Morgan want it? It's definitely not about the $20 billion in loans. As we mentioned, that's a tiny fraction of their business. The real prize here is something far more valuable. First and foremost, it's a demographic goldmine. Nearly 40% of Apple Card holders earn over $100,000 a year. These are millions of affluent, tech-savvy, high-spending Americans. For JP Morgan, this is a direct pipeline to new customers to whom they can cross-sell mortgages, auto loans, investment products, and business services. It's an incredible customer acquisition play. Second, this deal deepens their already strong partnership with Apple. JP Morgan was already involved with Apple through Apple Pay. Now they're planning to collaborate on an Apple-branded savings account, creating an exclusive suite of financial services for the massive Apple ecosystem. Co-branding with the world's most valuable company is an invaluable marketing asset. Third, it cements their market dominance. JP Morgan was already adding millions of new card accounts every year, and their card sales volume has been steadily climbing. Adding the Apple Card portfolio solidifies their position as the undisputed #1 credit card issuer in the nation. Finally, and perhaps most importantly, it's about the data. An analyst at Pagility Advisors put it perfectly. JP Morgan would gain many millions more customers who have Apple iPhone demographics, and they can see what else those customers would be interested in. That transaction data is the key to unlocking immense cross-selling opportunities across their entire bank. Let's look at how the negotiation went down, because this is where JP Morgan really played their hand perfectly. When Goldman announced they were looking for a buyer, all the big players came circling: American Express, Synchrony, Barclays, Capital One, and of course, JP Morgan. But there was a major problem. The portfolio was filled with more subprime borrowers than a bank like JP Morgan would typically take on. JP Morgan made it clear they would only take the portfolio if both Goldman and Apple were willing to make some serious concessions. One by one, the other potential buyers dropped out of the race. The risk was too high, or the terms weren't right. Soon, JP Morgan was the last bank standing. And when you're the only buyer at the table, you have all the leverage. They used that leverage to secure some incredible terms. They acquired the $20 billion portfolio at a discount of more than $1 billion. They got Goldman to essentially pay them to take it off their hands. They set aside that massive $2.2 billion provision, preparing for the defaults they know are coming. They negotiated a full 24-month transition period, meaning Goldman has to continue running the operations and dealing with the headaches while JP Morgan gets its own systems ready. MasterCard remains the payment network, ensuring a smooth transition, and they secured a commitment from Apple to collaborate on future financial products. As one analyst from Truist Securities noted, this was a great use of their excess capital, and that JP Morgan has the scale, tech, and experience to run this portfolio at an attractive return. They knew exactly how to turn Goldman's failure into their own strategic victory. So, what does all of this mean for you, the American consumer? If you're one of the 12 million plus Apple Card holders, here's what to expect. For the next 2 years, not much will change. Goldman Sachs will continue to operate your card, so your rewards, features, and benefits will remain the same. It's business as usual. But after JP Morgan officially takes over, you can expect some shifts. Initially, they'll likely preserve the existing features to ensure a smooth transition. But over time, look for deeper integration with Chase's own products and services. You might see cross-promotions for Chase bank accounts, mortgages, or their Sapphire and Freedom cards. And one thing is almost certain: lending standards will get tighter. If you're thinking about applying for an Apple Card in the future, you should expect tougher approval standards. JP Morgan is not going to repeat Goldman's mistakes by approving subprime borrowers so liberally. They've already budgeted over $2 billion for losses on the existing portfolio. They're not looking to add more risk. The bigger picture here is the accelerating merger of big tech and big banking. Apple provides the sleek user interface, the ecosystem, and the loyal customer base. JP Morgan provides the rock-solid financial infrastructure, the regulatory expertise, and the risk management. For consumers, this could mean more seamless and integrated financial experiences, all handled through the devices we use every day. But it also means that these mega institutions will gain unprecedented access to and insight into our financial lives. This deal is more than just a headline. It's a glimpse into the future of banking. Thanks so much for watching. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the world of finance and business. See you in the next video.